Let's now look at illustration number 1. Entity S enters into a 100 crores notional amount, 5-year, pay fixed and receive variable interest rate swap with counterparty C. The interest rate of the variable part of the swap is reset on a quarterly basis to 3-month secured overnight financing rate. The interest rate of the fixed part of the swap is 10%. Let me take a pause over here and let me actually plot it. So there are two entities, entities S and entity C. Entity S has entered, they've both entered into a swap agreement wherein S will actually pay C a fixed interest rate of 10%. 10% fixed interest rate is what entity S is going to pay C on a notional of rupees 100 crores. The notional is rupees 100 crores and the term is 5 years. All right, the term is 5 years, which means each year entity S will actually be paying rupees 10 crores to entity C, 10% of 100 crores. So every year entity S will make 10 crores payment to entity C. In exchange, entity C is actually going to pay floating rate, and that floating rate has been given as SOFR rate. All right, it's secured overnight financing rate. So what entity C will do is it will actually see what the secured overnight financing rate is at the beginning of the period, and entity C will be required to pay that percentage to entity S. Let us say if the floating rate is 12%, then C will be required to pay 12 crores to entity S. All right. So depending on what the floating rate is, if let's say floating rate is 9%, then C will pay only 9 crores. All right. It will be applied on the notional of 100 crores and the cash flow from C to S will be determined based on the floating rate. Now, this is the interest rate swap that they have actually entered into. Let's continue reading the question. Entity S prepays its fixed obligation under the swap of 50 crores at inception, discounted using the market rate of interest. What the question is saying is each year entity S is required to pay entity S rupees 10 crores. All right. So if you actually plot down the obligations that entity S has, it will have to actually pay it will have an outflow of 10 crores at the end of year one, 10 crores at the end of year two, similarly 10 crores at the end of year three, year 4 and year 5. All right, so it is actually going to have an obligation of 10 crores to be paid at the end of each year because the term of the swap is 5 years. Therefore, the obligation is going to exist for 5 years. Now, what entity S is doing is instead of actually paying 10 crores at the end of every year, instead of paying 10 crores at the end of year 1, year 2, year 3, year 4 and year 5, what entity S is saying is I will actually discount all these using the current market rates and I will actually make a lump sum payment now itself. All right, let's say 50 crores discounted value is equal to 45 crores. All right, so entity S will be making an upfront payment of 45 crores, which basically represents the present value of the 10 crores that entity S is obligated to pay at the end of every year for the next 5 years. All right, so once this 45 crores is paid by S to C, then entity S will no longer have to make any payments under the interest rate swap. Entity S will no longer actually have to make the payments under the swap. Entity S will only be receiving the floating rate. Entity S will only have an inflow and there won't be any additional outflow that is required to be made. All right. So entity S is prepaying the fixed obligation of 50 crores discounted using the market rate. I am actually telling you that let's say the amount is 45 crores. Now, what it states is entity S retains the right to receive interest payments on the 100 crores reset quarterly based on 3 months offer over the life of swap. So, entity S has retained the right to receive the floating rate of interest. After making the upfront payment, entity S basically receives the right to receive the floating interest rate. All right, the question actually mentioned that it's based on quarterly reset or 3 months offer. While explaining, I explained it as if it was an annual reset. All right, I explained it as if it's an annual reset, which is completely fine. If it was a quarterly reset, then the changes would be that entity S would actually keep making a payment of 2.5 crores every quarter, and it will actually receive a quarterly interest payment. All right, instead of paying 10 crores at the end of each year, S would keep paying 2.5 crores at the end of each quarter because the question actually mentioned a quarterly reset, but otherwise the concept remains the same. Now the question is analyze. The analyze is basically evaluate whether this is a derivative contract or is not a derivative contract. Now the focus of the question is on evaluating whether the initial investment is actually low or is not low. All right, because we are actually prepaying our obligation, the question is trying to focus on whether the initial investment in this contract is actually low or is not low. If it is low, then it will qualify as a derivative contract. If it is not low, it will not qualify as a derivative contract. Now, what I actually told you earlier is to evaluate whether the initial investment is low or not low, what you actually need to do is you actually have to calculate the cash flow under the derivative contract, the cash flow under the derivative contract that you're making initially, the initial cash flow under the derivative contract divided by the cash flow under the spot market. All right, to get a similar position in the spot market, what is the amount of cash flow that you would typically have to make? All right, we are required to actually check these two, and we are required to see what percentage this is. If this percentage is a small percentage, then it would actually amount to a derivative contract. If this percentage is a large percentage, then this contract will not be classified as a derivative contract. All right, for the avoidance of doubt, I'm just clarifying that the cash flow under the derivative contract will only be the initial cash flow. Now, to enter into this position in the derivative market, how much amount are you required to pay? What is your initial investment that we are actually making divided by the cash flow that you would make for a similar position in the spot market? The initial investment under the derivative contract, we are presuming, let us say, is 45 crores. All right, I'm assuming that this is actually equal to 45 crores. The present value of 50 crores discounted at the current market rates, I'm presuming that it is 45 crores. All right, now the question is, what is the comparable position that we have actually in the spot market? All right, my position in the derivative market is where I'm actually going to receive SOFR interest rate for the next 5 years. Now, I want to actually see what is a comparable position that I can have in a spot market. If you think of it, the comparable position in the spot market is going to be an investment in a floating rate bond. All right, if you think of it, S is actually receiving interest rate in the form of floating interest rate, which is equal to SOFR. It would also receive the same floating interest rate if it would have invested in a floating rate bond. All right, so the comparable position for this derivative contract, the comparable position for this derivative contract would be an investment in a floating rate bond where the coupon rate is exactly equal to the SOFR rate. All right, so the comparable position in the spot market, I'm just writing it down. The comparable position in the spot market is going to be an investment in the floating rate bond. Investment in a floating rate bond where the coupon rate is equal to SOFR. All right, floating rate bond where the coupon rate is actually equal to SOFR. Now, if I purchase a floating rate bond where the coupon rate is equal to SOFR, then if you think of it, S will actually receive the floating rate coupons every year, which is exactly its position under the derivative contract as well. Under the derivative contract as well, it's going to receive floating interest rate, and if it would have invested money in a floating rate bond, then also it would have actually received floating interest rate. So the comparable position to this derivative contract is an investment in a floating rate bond. So I now have to see what would be the cash flow that S Limited would have had if it would have actually made an investment in a floating rate bond. What would be the cash flow for it to actually purchase a floating rate bond where the coupon rate is equal to SOFR rate? If you think of it, generally floating rate bonds trade close to par. All right, they generally trade a little close to par. The par value over here is actually equal to rupees 100 crores. The par value is nothing but it is equal to 100 crores. So floating rate bonds price is usually close to par. So I would say that it's going to be close to 100 crores. It's going to be approximately equal to 100 crores. So the amount of outflow that you would actually have to purchase a floating rate bond would be 100 crores, but you were able to enter into a similar derivative contract where you are actually receiving floating interest rate by having an initial investment of only 45 crores, which means that the percentage that you have invested is 45 percentage, and we will still consider this as a low percentage itself. All right, we are still going to consider 45 percentage. You might actually think that 45 percentage is a very high percentage, but 45 percentage is actually still considered to be a low initial investment. All right, we still consider this as a low initial investment, and we are going to say that this satisfies the definition of a derivative contract. All right, the amount of initial investment that we are going to have under this derivative contract is the present value of the 50 crores, which I assumed to be 45 crores. I've just taken this number for the purpose of explaining. The question did not have this number, and the cash outflow that I would have to enter into a similar position in the spot market would be 100 crores. How did I get the 100 crores? I said that the comparable position in the spot market is basically an investment in a floating rate bond. An investment in a floating rate bond typically trades close to par. It's not going to be necessarily 100 crores, but it's going to be very close to 100, say 99 or 101 crores. So therefore, the percentage is going to be approximately 45 percentage, and 45 percentage is going to be considered as a small percentage only. All right, to enter into a position, I would have had to actually spend 100 crores. Instead of spending 100 crores on the spot market, I was able to spend only 45 crores under the derivative market, and therefore my initial investment is actually low, and I will be classifying this prepaid interest rate swap. This is called as a prepaid interest rate swap. This will still be classified as a derivative contract itself. All right, so the journal entry would actually be derivative asset debit of 45 crores, credit cash of 45 crores. All right. Unlike the previous illustration where I debited the investment in equity, over here I'm only going to debit the derivative asset. I'm not going to debit the investment itself. All right. Let's actually read the solution of the institute. The initial net investment in the interest rate swap is significantly less than the notional amount on which the variable payments under the variable leg will be calculated. All right. The initial investment in my example was 45 crores, and the notional was basically equal to 100 crores. All right. To purchase a floating rate bond, you would have actually had to spend 100 crores, but you are actually spending only 45 crores. And therefore, we are going to say that this is less than the significantly less than the notional. The contract requires an initial net investment that is smaller than what would be required for other types of contracts that would be expected to have a similar responses to changes in market factors, such as a variable rate bond. All right, the investment in the variable rate bond would have been 100 crores, whereas you are investing only 45 crores. Therefore, the contract fulfills the condition of no initial investment, or in initial net investment that is smaller than what would be required for other types of contracts. Even though entity S has no future performance obligation, the ultimate settlement of the contract is at a future date, and the value changes in response to changes in SOFR. Accordingly, the contract is regarded as a derivative contract. All right, this is basically checking for the other two conditions. It has to be settled at a future date, and the value should change in response to an underlying index. Since both these conditions are also satisfied, the contract will be regarded as a derivative contract. All right, so there are totally three conditions for a contract to be classified as a derivative contract. One is the value should change in response to an underlying. The second is the initial investment is supposed to be low, or it is supposed to be or it is supposed to be zero. And the third one is it is required to be settled at a future date. Over here, it's going to be settled at a future date because on a future date, entity S is going to receive the floating interest rates. All right, so that is with regards to illustration one. One reference that I would like to actually mention is IFRS does not prescribe any threshold over here. IFRS does not really prescribe any threshold of what percentage this can actually be under. All right, is 45% low, is 20% low, or is 30% low, or is 60% low? IFRS does not really prescribe any percentage. US GAAP prescribes a percentage of 90 percentage. US GAAP prescribes a percentage of 90 percentage. What they're saying is if the outflow under the derivative contract is less than 90 percentage of the outflow under the spot contract, if the outflow under the derivative contract is less than 90 percentage of the outflow under the spot market, then the derivative will be accounted for as a derivative. All right, the derivative contract will actually be accounted for also as the derivative. Let us say under the swap contract we had an outflow. Hypothetically, if we had an outflow of, let's say, 89 crores also, then still the swap contract would have been accounted for as a derivative, because 89 divided by 100 is only 89 percentage. Therefore, we are not breaching the 90% threshold, and therefore it can be accounted for as derivative. All right, so the outflow under this swap contract should not exceed 90 percentage of the outflow under the spot market. All right, it cannot exceed the outflow under the derivative contract cannot exceed 90 percentage of the outflow under the spot market. Obviously, IFRS does not prescribe this. Under IFRS, you are required to apply your own accounting policy. There is no hard bound threshold. You're obviously required to apply your own thresholds over here. All right.